Yo guys, welcome back to Stock Talk Insider. Today I will be talking about the whole performance of the market and where I think we're headed, and that backed by a lot of information that I've gathered together for you guys. I will be talking in a minute about all of those things. But before we do, I really appreciate you guys for all of the support. I've started uploading again since beginning of August, so almost 4 whole weeks. And yeah, the support is very good, and I very like uploading videos just to give you guys a perspective of another investor in how he sees the market and how he operates in the market. So, no further questions asked. Thanks for the support. If you can do that again, leave a like, and if you really enjoyed the video or already enjoyed other videos and you're not subscribed but you want more of this, subscribe please. And yeah, let's get to 100 subscribers, because that's really giving me a boost for uploading more and more and more. But of course, still, I really do like doing YouTube, just because I like talking to the camera and just expressing my interests. So, having said all of that, let's get straight into it. So, what have I for you guys today? So, welcome back to the channel again, by the way. So, we will explore some questions like: is the AI hype growing too fast? Are we headed for a real recession, or will it just be a temporary market dip? Also, we will just look at some broader market perspective numbers. Also, we'll break it down step by step by using the latest economic data, corporate earnings, consumer behavior, and financial markets. So stick around. So what will I say? Well, I will actually just very simple go over all of the consumer data, all of the unemployment, and just actually the macro data about the market itself and where we're at. Not in particularly where we're headed, because no one knows that, of course, but I will just talk about its recent performance of those points I just mentioned. So, starting with some economic indicators. So yeah, let's start with the macroeconomic in the United States, which is number one, the yield curve. The yield curve shows the difference between short-term and long-term government bonds. Normally, longer-term bonds pay more interest due to greater risk. When short-term rates exceed long-term rates, that's called an inversion, historically a warning for a recession. Right now, the curve is not inverted, meaning investors aren't expecting an immediate recession. So, looking at the yield curve, we can't get any information if there would be a recession because of that, because that's actually steady. So, going further with the unemployment. So the employment is currently at 4.2%, as you see, from July 2025. It's slightly up from the previous months. The lowest this year was around 4.1. 4 to 4.1. Job growth is slowing in July. Only 73,000 jobs were created compared to 123,000 jobs a year earlier. This suggests a cooling labor market, but not yet a crisis. So there are signs of a little bit of cooling into the market, but it's not that diabolical that it should be very, very, very bad. It is a little bit cooling off, but we're literally talking about 0.02, 0.1%. So yeah, that's what we're talking about. So there is a cooling off. We would like to have that going down, these percentage. In between 3 and 4 is actually very steady. But still, if you look at where we were in the last couple of years, well, we are actually very steady at this point. If you keep it like this a little bit, of course, we will have times where it goes up again, but that's just the normal flow of life and of the market. So yeah, there's nothing to do about that. But for now, we are steady, and there is nothing that we can get out of this that will literally give you a recession or something. It is a little bit cooling off, but yeah, further than that, we can still go forward. Some consumer confidence and spending. So the consumer's confidence, this is this one here. Yes. The consumer confidence index is around 97, but the future expectations component fell below 80. People are becoming more cautious with spending, which is actually not that good, of course, because you want people to spend so the market can grow and the economy can grow and companies can have a lot more profit. Yet retail sales are still growing, especially online in food service. Consumers are showing increasing price concessions, which could signal caution in spending habits. So having said that, we have some S&P 500 sectors corporate earnings graphs. So then we need this one. So in Q2 2025, S&P 500 companies reported nearly 12% year-over-year earnings growth, which is strong performance, especially in technology and communication services. But not everything is rosy. There were 46 negative earnings warnings for Q3, so the coming quarter, mostly in energy and cyclical sectors. This shows that some companies are still vulnerable, especially those sensitive to rising cost and economic slowdown. Stock market often react 6 to 12 months ahead of an actual earnings decline, so this is worth watching closely. So having said already all of this, the thing where I'm looking the most at right now is not yield curve, not unemployment, because yield curve is in line and unemployment is literally a little bit of cooling off, but not that bad. Consumer confidence is one I'm looking at, but the bigger one is actually the negative earning warnings from mostly in energy and cyclical sectors. That's one I'm watching. And further down that, that's actually what I'm looking at. Further, I'm not really getting, So the negative earning warnings for those sectors, and then just a little bit of the consumer confidence is where I'm looking a little bit at. But yield curve and employment looks fine for me. So having said that already all, we have some financial stress things we can talk about. So the St. Louis Fed Financial Stress Index is at minus 1,161. So, and the OFR Financial Stress Index is minus 1,183, indicating low financial stress. So still low. Recent US bank stress tests show that major banks have enough capital to weather a severe recession. This means a financial crisis is not likely right now. Banks and credit markets remain stable. Also, the rates are still very high, and we have a lot of room to cut. So if there's a recession, the Fed can go very low and make a lot of cuts, which will, backbone a lot of support against a recession. So actually, having a recession right now is still a long way to go, but there can always be a forced recession or something. You never know. Everything can literally happen. But based on this macro data, like the unemployment, like the yield curves, like the corporate earnings, the unemployment, the consumer confidence, all of those things, some financial stress indexes. If you look at all of those basic things, there's not really much to look at to say that there will be a recession. So having big dips is still something that's always possible, but a recession at this point is probably not going to happen. But further in the video, I will talk to you guys what I think will happen. So before we get to the conclusion, I still want to talk a little bit about the AI hype. So investments in AI are growing, so at an unprecedented pace. Some startups are valued in the billions before even making a profit. This could lead to classic bubble where hype outpaces underlying economic value. On the other hand, AI's genuine productive revolution, potentially making companies more efficient, opening new markets and driving economic growth. So companies don't really need to make profit because the product itself, AI, is already proving that they can do such magical things that a bubble would probably be a little bit ridiculous, because the product is just AI in itself. The product is just too magical to bring it down because of a bubble, maybe because some companies are not making profit or things like that, or getting all of those things in line. That's a little bit ridiculous in my opinion. So I think that AI hype is still very strong. AI can literally be used in every component of life, but still, of course, we have to take a little bit of the basics and look at how far we are, and we don't want to walk ourselves before we are actually where we need to be. So yeah, in my opinion, AI hype is still very good. AI could be both a risk for market correction and AI driver of future growth. So that's also one you need to choose of, but still, I think that it's a driver of future growth. Conclusion of all of this is, so yeah, what can we expect? No immediate recession. So as I said, economic fundamentals are mixed but not alarming. They're more steady than alarming. Potential market dip, cooling employment and cautious consumer sentiment, and AI hype could trigger a temporary stock correction, especially in overvalued tech stocks. Long-term risks, if interest rates remain high and companies report disappointing earnings, a recession in 2026 could occur. The takeaway is stay alert, follow the data, and be aware of the AI hype versus real economic fundamentals against it. So yeah. Then now my perspective is what will happen in the coming year to 2 years. So I believe, in the coming 2 years, we will have a little dip here and there as always. But now September is almost at, it's at our doorstep. So we will go into September in a couple of days. And starting from September, I do believe that the stocks will get a breather, very, very nice big breather maybe. And at the end of October, we will be back at the highs of today. And I think that by end November, mid-November, going into December, we will have new highs. And then in 2026, we can get a new breather. And then between 2026 and 2027, there will probably be a recession because eventually things like the macro data will be a little bit more alarming. People will get stressed out because we are already in such a long all-time high cycle, and we will get a bigger breather. That's what I expect. That's what normally should be a logical play to play out. So yeah. That's what I think. That's my opinion. That's my story. That's what I think will happen. So you can take it how you want. This is a portfolio at today highs. So we have cash of 4,600 euros, a total invested amount of 51,000, and a total account of 55.8 thousand. Of that is 23.6 thousand profit. We were at around 25.4 thousand in this week's highs of total profit. But yeah, we went down on Friday because Friday was a red day. I want to talk. What want to say? Yeah, I want to thank you guys for watching this video, and I'll see you guys later.